Let's dive right into TD Power Systems. Over just 5 years, this company has gone through a really incredible transformation. It's become a major player in this huge global theme, the electrification of everything. So what we're going to do is explore just how this Indian engineering firm took advantage of some massive geopolitical and economic shifts to become a true international powerhouse. And a huge piece of this puzzle is the global China Plus One strategy. You see, TD Power really managed to pivot. They went from being primarily a domestic generator manufacturer to a critical international infrastructure provider. By using their Indian manufacturing base as a launchpad, they've set themselves up as a super reliable alternative, and now they're supplying key markets all across Europe and North America. So the big question is, how'd they do it? How did they pull this off? Well, it all started by carving out a very strategic niche and sticking to a core philosophy that really guided every single move they made. Let's break that down a bit. Okay, so the company's competitive advantage, its real moat, is all about high-precision engineering. They don't try to be everything to everyone. Instead, they focus on one thing: specialized synchronous generators, specifically in a power range from 1 megawatt up to 200 megawatts. But what's really fascinating is how diverse their customer base is. With this one core skill, they're serving everyone from traditional hydro and gas to renewables like wind, and even into high-margin industrial motors. Now, here's a really pivotal moment for the company. They made a conscious strategic shift to value over volume. This meant they actively walked away from low-margin, commodity-type products. Their focus became entirely on customized, high-efficiency solutions, even in newer areas like green hydrogen. And the result of that discipline? It's been incredibly powerful. Just look at the consistent EBITDA margin expansion they've posted over the last 8 quarters. And that strategic discipline really sets the stage perfectly for the bull case. So let's dig into the key growth drivers that have so many investors feeling optimistic about where this company is headed. One of the single biggest growth drivers has been this data center breakthrough. TD Power locked in a multi-year supply contract for standby power generators in North America. And this is huge. It represents a massive, non-cyclical demand tailwind, and it basically validates their entire international expansion strategy in one fell swoop. And the financial numbers, well, they really back up this bull thesis. Think about this. Export markets now make up more than 40% of their revenue, and these are high-margin sales in places like the US and Europe. The company is delivering a return on equity of over 22%, and they're doing it on a debt-free balance sheet. That's a powerful combo. To top it all off, the domestic pipeline is still very steady, thanks in large part to India's big push in renewables and pumped hydro storage. But, of course, no analysis is complete if we don't look at the other side of the coin. It's time to really assess the core risks and the headwinds that make up the bear thesis. So the risks really fall into 3 main buckets. First, there's valuation discomfort. Let's be honest, the stock is trading at a pretty significant premium to its historical average. That doesn't leave a lot of room for error if earnings miss. Second, the commodity squeeze. Their business is sensitive to copper and steel prices, right? And there can be a lag in passing those higher costs onto customers, which can definitely squeeze margins in the short term. And finally, you've got global headwinds, things like low-cost competition from China and the potential for a capex slowdown in some of their key markets. Now, to really get how we ended up with this bull versus bear standoff, you have to look at the company's recent journey. Coming out of the pandemic in fiscal 22, the game was all about recovery, but that changed fast. In fiscal 23, they made an aggressive pivot to exports in Europe, which then led to a major capacity expansion in fiscal 24 just to keep up with all that new global demand. And that momentum just kept building into fiscal 25, which you could really call the margin expansion era, as they shifted more towards solution selling. This all led to a period of peak performance by the third quarter of fiscal 26, where they were delivering consistent earnings per share growth of over 25%. And that right there is what drove the massive re-rating of the stock. Which brings us right here to the final section where we pull it all together, the bull and the bear cases. And honestly, it all comes down to one thing: the execution mandate. Ultimately, this whole bull versus bear debate, it really hinges on the execution of one single, incredibly powerful number: 2,800 cores. That single figure is the size of TD Power's current order backlog. And honestly, it changes everything. So, this massive order book, it's both a huge opportunity and a huge challenge. Management strategy is crystal clear. They have to deliver on this backlog while at the same time de-risking their manufacturing footprint.
And you can see them addressing this head on with the recent appointment of a new chief operating officer, someone whose background is specifically in global supply chain optimization. That's no accident.
So this leaves us with the one central question that really captures the entire story here. With a record order book that gives them clear visibility for growth for years to come, can the company's actual execution and delivery outpace the market's very real and very high valuation concerns? That is the question.